we're on to dividends and just what are they? You're going to find out how they're great, actually. They're really a cool thing to get as once you're an owner of a corporation. So looking at that, well, what are they? They are a distribution of current or prior year profits, and it's those prior year profits all combined that make up what's something called retained earnings. So a dividend is the distribution of profit, really, is what it is. A dividend's declared on a certain date, then what that means is that on that date, there's a legal liability for the company to actually pay that dividend to the shareholders. And subsequent to that, there's the date of record, or the date the shareholders of the company are determined, and it establishes who will receive the dividends. The distribution date's the actual date that the dividend is paid to the shareholders. So it would, this could all be a very short period of time, but there's 3 distinct dates in there that those distributions are declared, recorded, and distributed. Now, there are different kinds of dividends, especially on preferred shares. On preferred shares, we've got dividends that are often paid annually, and they may be paid when scheduled, or they may fall into arrears, meaning perhaps we pay a 6% dividend every year on our shares, and we issued them for $100 each, so we normally pay a $6 dividend every year. If we don't pay it in this year, then we have to look and see whether or not the preferred shares are cumulative or non-cumulative. So if a company has issued preferred shares and they're cumulative, then the dividend not paid in this year carries forward and it has to be paid in a future year. Now, if the dividend's non-cumulative, then the dividend, if it's not paid in this year, doesn't carry forward, it's just lost. So the shareholders lose that opportunity to get that dividend. And dividends, if they are cumulative, and they're not paid in the current year, but they've got to be paid in the future, well, that liability or that need to pay that dividend is disclosed in the financial statement notes. It's not recorded as a liability on the financial statement, but instead in the notes we say, oh, we've got to pay these cumulative dividends here down the road. Now, there are different values for shares. Market value is the value of the share on a stock exchange. So if I had shares in a big company and I wanted to trade them or wanted to sell them, then I do that on a stock exchange. And it all depends on what the price is of those shares at that particular time that I want to trade. They go up and down in value all the time. There's something called the book value of shares, and really that's the value of the shares based on the company financial statements. And here's the formula that we would use, usually total shareholders' equity minus whatever the preferred share equity is over the number of common shares. So in other words, what are the common shares going to get out of this company if it was to be shut down? And we paid out the preferred shareholders, what's left over, and how much is that for every share that's outstanding? Book value is not necessarily good value for investors to use. If you look at the book value of assets, we've seen it many times where that differs from the fair market value of company assets, but sometimes that's all we got, and so we have to go with the book value sometimes. And an investor looks at a company in many different ways, and there are a couple of key ratios that they look at. Something called return on assets. It's really a measure of how the company is successful or creating profit using assets to earn income for both creditors and shareholders. So in this case, it's really a simple calculation. It's whatever the net income is for the year, adding back the interest expense, and then dividing by the average total assets. So at the beginning of the year, we could have $27,729 in assets. At the end of the year, we've got $26,406 in assets. What's the average? Well, $27,000. And our profit, whatever it is, add back the interest expense, whatever that is, that number divided by that number will give you a return on assets. If you were earning 6% on assets, does that sound like a good number? Maybe, maybe not. There's something called return on shareholders' equity, and that specifically eliminates the value, excuse me, or the success attributable to preferred shareholders and creditors. And what it basically does is it looks at the net income, again gets rid of the preferred shareholders dividends, whatever they are paid or will be paid, and putting it over the average common shareholders equity. So if we've got a certain amount invested in this company and we look at the net income, how much are we making on that after we pay out the preferred shareholders? Sometimes that's a good measure of how successful a company is. In this case, it looks like it's a 15.86% return on shareholders' equity. Does that sound like a good number to you? Does that sound like a pretty good return? Maybe, maybe not. There's something different between return on assets and return on equity, and it's basically something called leverage. We can go and borrow money, say at 6%, but earn 10% from our operations. And so that difference between that two, that in this case about 4%, is called leverage. In very good economic times, when you can use money that you're only paying 6% on, but you can make 10% on the money as it's invested, then that's a good move. That sounds really good because we've got extra profit. But if we're borrowing money at 6%, but we're only earning, say, 2% in profit, then that doesn't make a lot of sense. That can actually hurt the shareholders. So we have to be very careful with that. Just a couple other little things. Return on equity and return on assets, they're all financial measurements to evaluate the success of companies and for potential investors or current investors just to make informed decisions about what they should be doing. And one last thing, organizational costs such as legal fees, underwriter fees, selling commissions, that sort of thing on IPOs, they're all set up as intangible assets on the balance sheet. So kind of an interesting thing that you see. Some of those numbers can be pretty big, but yeah, they end up as an asset on there, not claimed as an expense.